So, hi everyone, once again, and let me take a moment to introduce our guest for today. Today we have with us Ankush Agrawal. So, he's a qualified chartered accountant. He has over 8+ years of market experience, which includes various professional roles at multiple research and fund management firms. Lately, he had founded Surgecapital, which is an equity research firm which provides institutional quality research to retail investors. And with this, I request Ankush if he has any opening remarks.
Hi, friends. Thank you for inviting me, and I appreciate everyone who has joined today for this call. Thank you. Sunday.
Great. So, Ankush, would appreciate if you tell us, how had been your entry to the markets, how it all started for you. Was it some legacy element, someone from the family was into it, or it's all serendipity which brought you in the markets, and how it had evolved over a period of say last 8 to 10 years, in whichever you had been in the market? Yeah.
There is no family link as such. It's not, I'll say, serendipity or something. So, like being a CA, I think a lot of people like who are CA could relate that when we are into internship, which is called articleship. So you'll always have some senior or the other guy who is into stocks some bit, right? So same thing played out with me as well. Like when I was in my internships back in 2014, that time I saw some of the people in seniors in the office used to trade stocks, right? And they used to talk about Rakesh Jhunjhunwala at that time. So till that time, I didn't even know who Rakesh Jhunjhunwala was. So I just Googled and I got the old Wizards of Dalal Street episode of his, right? And after seeing that, I got a lot fascinated because I could relate a lot of things. Like I was like, this guy is also a CA who started so small and now has become big. So that's how I entered the market. Initial days, obviously, like how everyone does, like you are like very naive. So like I started with like intraday trading in those days, right? So it's a very funny story that the very first day I made a trade, I earned about some 5K or something on an intraday trade. I remember very specifically that stock. It was like Tata Power that time. So, when you make your money initially, now you feel that, it's easy and you'll do it like, you'll be on the top of the world. So, like, you made 5K one day, and I thought, 5K multiplied by 65 days, this is what I learn every day now, right? But eventually, market does what it does. So I blew my account in like 2, 3 months. I did it again, and that is when one realizes that it's not that easy, and you need to have some learning. You need to have some kind of framework to start it. So that is how I started that in those days. Like initially, you lost money trading, and then you go out, try and find new things, some information, try it again. The good part about starting with trading is that you can experiment quite a lot because what happens is if you learn something, you can take 5, 6 trades in a week and you get the feedback, what is working, what is not working. If you start with investing, what happens is even if you learn something, you apply it, you get the feedback in like 6 months, 1 year, 2 years, right? So trading helps you in the initial phase in losing money and realizing that there has to be some kind of process and framework. So that is how I started. So those were the initial days. I think 1, 2 years I did that. Uh, by that time, I had completed my chartered accountancy, and like I was sure that I want to do something in the market itself. But till that time, I was also very clear that if you have to become big and go long in the market, it has to be through investing. Trading won't help. And like I said, in investing, the feedback loop was very long. So if you start, I thought that if I start doing investing of everything on my own, it will take quite a long to just to learn it. So that's when I decided that let me take some professional role somewhere so that I can learn it. So that's how I like then came to Mumbai and I worked like about 3.5 years in some of the research and fund management firms and learned how investing is done. And then now I'm doing my own research now. So that is like a broad story what has happened.
So Ankush, like how easy or how difficult it was for you to enter, and like you told about, like you spent 3.5 years initially, and so the entry into research is not an easy thing. But I can see like being a CA, good with the numbers and financials is one thing which is an advantage. So how had been those years when you started?
Yeah, so initially it was tough because what happened was, without having any experience or, typically what I saw that time is, a lot of big broker firms and all that people used to take candidates from, IIMs and, MBAs and those sorts of guys without experience, right? So that is where serendipity played out because that time what used to happen was I used to read Money Life's magazine, right? And like that time, I was trying to find some role over there, like in the equity research, and I just saw an ad on their website, equity research analyst required. So that's when I applied and I joined there. Luckily, like being a CA, and they took me. So that's how I started over there. And like over like being in the markets, like my initial goal was that, irrespective of what kind of role I get, I just have to be in the market so that, if your full-time job itself is in the markets, right? Even though the job is not teaching you anything, you yourself can learn because basically you're getting paid to do the same work, right? So that's how I entered. And then over time, once you yourself learn, then you can switch, right?
Right, Ankush. So, Ankush, what is central to your investing? Having said that, like how you start with getting the ideas or generating ideas, and then you deep dive on those ideas and choose from those ideas, and finally get into investing in some company. So, how the process goes and how it had evolved over a period of time for you, and what elements you see remain the same, and what are the elements which are ever changing and one has to move along with them? Yeah.
Right. So initially, a good thing that happened to me in my early days was that the very first book I came across in markets and read was William O'Neill's How to Make Money in Stocks. Uh, I mean, irrespective of the system, if you're not interested in that system itself, the good part about that book is that it tells you that there has to be a framework for everything. That there has to be framework on how you will screen stocks, what you will look into stocks, when you will buy, how much you will buy, when you will sell, and all those stuff. So from very beginning itself, I think there was this understanding that whatever I have to do, there has to be a framework out of it. I'm not going to do anything out of it. So initially, like since I read William O'Neill's book, so I tried to follow a can model, right, wherein you look for chart patterns and combine it with quantitative growth. So if you have a good chart pattern breakout and you have recent quarters of earnings growth, you buy it. So I did that in the initial periods, like before going to professional roles. But the thing that I realized that you know what happens is if you try to mix technicals with fundamentals, like if you say if you want to do 50% technicals, 50% fundamentals, that does not work because on the technical side there's a lot of noise. So say William O'Neill say look for breakouts and then look into fundamentals or whatever. But if you go and look out for breakouts, like at any given day or week, you'll get hundreds of breakouts, right? And most of those breakouts don't succeed. So over time, I realized that the majority of your research and understanding has to go on the fundamentals, and then for some specific inputs, like getting an initial idea. So if a stock is hitting new high, just look at it. Like something might be happening, right? When to buy, how much to buy, when to sell. For those kind of things, you can use technicals. Otherwise, in the end, it's not the price action that creates fundamentals. The fundamentals that plus overall market sentiments that would eventually create the price action. A lot of times price action might give you initial hint that something something interesting is happening, right? And that is one of the base of how I screen for ideas, right? So principally on a monthly basis, I track everything that's making new highs, right? So that is where primarily I get ideas. So if anything is making new high, I just go and see if what is happening in the company, right? Then in the end, then it's like a treasure hunt eventually, right? Because and some of the luck has a role. Luck has also has a role to play that you stumble upon something out of 100, 200 companies that you're looking at. Then I think the second thing that helps choosing in ideas is, I think, basic observation. Like right now, if you'll see, I think there are a lot of stocks that are being discussed on, let's say, Twitter forums. You have like analyst friends who are into investing. So like there are groups. So what one has to do is keep observing what is happening, right? And eventually, a lot of times you will come across things through this observation itself. So to give you an example, I think just a disclaimer, nothing what I say is a recommendation, just for uh, knowledge sharing purpose. So, for example, 2021, I got into music streaming, like Tiff, Saregama, and all those companies. Uh, for those, I think the initial idea came in when someone in one of the research groups just put the very first presentation of tips industry, right? So I saw eventually like it was the very first presentation. I just clicked and opened, right? And that's how I got the initial idea. Okay, this is happening in the company. Let's look at it. Otherwise, I don't think for any other ways I would have stumbled upon tips, right? So those are the kind of things like that happen. Like you need to have some kind of screening. Either you use technicals or you use fundamentals that if XYZ growth has come, margin expanded, whatever screens that you have to create. So all those things are the primary things that you do on your regular basis. And I think second thing is you keep observing, what is happening, what who is talking about. Like a lot of big, fund managers, investors comes on TV and talks about, this is looking interesting. So keep observing what everyone is talking about, and keep looking at. For example, someone comes and tells you about, okay, this thing is looking interesting, right? You don't have to go and buy it, but at least go and see. Because see, if you have a person who is full time into investing, right? He might be buying 20, 25 stocks, and he's saying that I'm looking into XYZ stock. So you have to pay heed to that, because this guy is full time into investing. Out of 15 200 2,000 stocks that are there, this guy has selected one, like this guy has to select 15 20 stocks for his portfolio, and he has selected XYZ stock. So at least something interesting would be happening, right? He's not a dumb guy, right? Because he's full time into investing, so some effort would have gone there. So you keep observing and then you look for stocks, right? I think that is basically the screening criteria, if I have to say.
Right. So, Ankush, like, is it like some specific sectors you look, or it's like across the market, all sectors are okay? And as far as like the approach is concerned, so it is more of a top down or a bottoms approach?
No, see, it's a bottoms up approach only. And I don't think for anyone who's full time into investing would have a criteria that, don't buy XYZ, don't buy this, right? Like, I think in the end, if you have to make money, you have to buy on the best opportunities, right? So, I mean, I don't think people should come with an idea with a preconceived notion that don't buy this, don't buy that, because in the market now everything changes, right? Someone will say, a company was, has XYZ issues in the past. Once the execution starts coming, that XYZ, so I mean, say management or company also becomes zero. So I don't think those things work in the market, right? So you have to be open-minded, because a lot of times things change. Like the promoters also change, the business dynamics also change. Like just like how I was talking about TIP for last 20 years, music businesses has not done anything because of piracy, right? But suddenly in last 4 5 years, the business has changed, right? So a lot of people did bought into these stocks because they thought, Bollywood and all those guys have never made money, right? So don't go out with that preconceived notion that, if you have heard something bad about XYZ company in the past, don't just avoid it. If something is happening, just look at it with an open mind that something might have changed, right? So the approach is bottoms up, and I think see the overall approach. I'll say everyone have basic, simple, same approach, right? Everybody wants earnings growth, and they want to buy at a cheap or reasonable valuation, whatever, right? The differentiation that everybody brings to the table is how they look at earnings growth, how they judge earnings growth, and how they boils down into that earnings growth, right? So what I have seen that based on my experience investing and based on looking at past successful winners, I've figured out that for me the kind of growth that I'm looking at, there are 6 7 factors which determines the long term earnings growth of a company. So I like the 6 factors that I look for is basically either the company might have a strong business model, right? Secondly, it might be innovating or pivoting into newer businesses, newer products. Right. Third, it could be an existing leader who has some kind of edge, and that would allow it to grow its earnings for long term. Right. Given the industry dynamics are favorable. Fourth thing you can look for is optionalities. So a lot of times, some companies might be working on some initiative which are small, but if they materialize, it could become a substantial business, and that's how the earnings growth might come, right? Another thing you can look at is what you call a strong management execution. So a lot of times, like there are companies, for example, if you take Shree Cement, right? So being a cement company, it has been a very good wealth creator. That's because Mr. Bangur has executed quite well. So eventually, I've seen that if I find a company wherein the company has either one or multiple of those factors, I'm quite interested in that because see, eventually what happens is what I believe is, you have to bet in a situation wherein the internal external environment is conducive for growth. Because in the end, execution, you don't know how much and when will it happen. Even the promoter doesn't know if he will be able to execute. So on that part, it's in the end, it's a leap of faith. Like it's a calculated guess. But if you have every other things which are conducive for growth, then your probability of getting a winner increases quite a lot. And then eventually, you can manage your risk and allocation based on your visibility and conviction on that bet. So that is broadly how I look at things
Ankush,
in this.
like the management thing is the most important thing, as we say, and it's like I mean, what we screening the management is one thing where retail find it really difficult because that is some can screen on some tools or maybe. So what exactly you look for in the management? I mean, how one can say, and where shall we draw a line, like that these things can be ignored as far as management is concerned? And like there is an opinion, management can either be good or bad. There is nothing in between. So any
Yeah. So yeah, that's true. I mean, judging management is very difficult. See, in the end, even in real life, it is very difficult to judge people that you know. Judging someone who you have not even met it, you are just hearing him on say earnings call and whatever. I think it's extremely difficult to judge, right? But having said that, the management quality is also relative in the market. Like if someone has XYZ issues and he's not executing, then that shows out bad, right? If he starts executing well, then a lot of times some bits the market tends to ignore that. So if XYZ promoter is executing, even in the past, if there are XYZ issues for the time period, market tends to ignore it, right? So just because there were some XYZ issues, I think ignoring it bluntly is not right. But obviously, the way you said that there has to be a line to be drawn. So the way I look at it is, you look at the moment what are the risks involved, right? So I'll just give an example without taking name of the company. So basically, this company had two businesses, right? It's a recent example only. So what happened was they demerged one of their businesses such that the manufacturing was kept in the earlier entity, only the marketing and distribution was given in the second entity, right? Initially, obviously, this was not a good thing, right? Second, what they did a year later, they said that now we are giving manufacturing business also to the demerged entity. But what happened with this whole transaction is that initially, if you would have demerged the manufacturing as well, you would have given manufacturing on the book value, right? Now, doing it after 1 year, you're giving all the assets, manufacturing, land, and everything at the market value. So basically, you have sort of shortchanged the demerged entity for XYZ amount of cash and got it into the original entity, right? So that's a bad thing, right? Secondly, they have not yet given some bit of land with an assumption saying that the land has a lot of value, so we don't want to put a lot of pressure on the demerged entity. We are giving it on rental. So that this land has say XYZ crores of value, and historically you have seen that recently they have tried to sort of siphon off money from the demerged entity. In the future, there's a risk that they'll say that you buy land also and give us this much money also, right? So this risk is there. In the past, they have done this thing also. So that's when you draw a line that, this is the risk. Either you want to accept the risk. If you don't like the risk, don't invest because this guy has already done this kind of thing. So eventually in the future he'll do it, right? So that's how you have to look at it. Otherwise, a lot of times there would be tail risk. That tail risk exists in every company. Even if say, for example, HDFC Bank merger is happening, right? Everything is good, whatever. But that tail risk is there. If RBI comes and says that we don't give this kind of relaxation and all that, then it could become a challenge, right? Same thing for say Bajaj Finance. Bajaj Finance, everything is good, but there's a tail risk that if RBI comes and says, you have to become a bank, so, that tail risk, don't ignore it, be aware of it, but don't avoid a company because of tail risk, because those are there in every company. If you start looking for company, wherein everything is good, I think your investable universe would be limited to a very few number of stocks, and that kind of investing is better left to be done by someone else rather than putting your whole time doing research.
So, Ankush, what would be your suggestion as far as a broad portfolio approaches, like how one should go about constructing a portfolio? What all pointers or I mean data points one has to look like, be it diversification or concentration, how or maybe exposure across various asset classes. So how you would suggest, and like particularly at Surge Capital, I mean, if you recommend some advisory, how one should go about reaping the best benefit out of it?
So see, over like last 8 odd years, I have been in the market. I think increasingly I have realized the importance of having a simple approach, right? See, a lot of people come with unreasonable expectation of 30-40%. I think it is doable, but I think if you have a simple expectation of 20-25% and you approach investing with that kind of framework, I think it's very easy to do, right? And what I've realized is, over time is the importance of finding resilient businesses, because what happens is if your business is resilient, the probability of business delivering unwanted surprises is very low, right? And the kind of quality of growth that is there is very secular and sustainable. So the market also gives benefit of the doubt. So even if we have 1-2 quarters of bad 1-2 bad quarters, the market will not bid that stock 40-50% down, because they know that the business is resilient, it has quality. So eventually, 1-2 quarters, there is trouble, but it will recover, right? And that 1-2 quarters of bad quarters also are not that bad. So if a company is growing like 15-20%, bad quarter would mean that it is not growth, right? It's not that it would degrow 15-20%, right? So, the overall earnings is also resilient, and the market, the kind of valuation that market looks for this company is also resilient. So, the overall volatility that you have to face is very low compared to some kind of B2B or B2G companies where in a good period it will deliver you 20-30% growth, but there could be quarters wherein it could degrow also 20-30%, right? So on one hand you have earnings degrowth also, and for these kind of companies the valuation band is very high. So in a good growth period this company might go from 20 to 40 times earnings, but in degrowth period it will again come down from 40 to 20, right? So during bad times you have twin challenges. Your earnings also degrowing and your valuations are also correcting substantially, right? And so for these stocks, the trends are also not that long, because it is very difficult in a B2B or B2G kind of companies to have this very long, 5 years, 10 years kind of earnings growth without any, intermittent disruptions, right? And when these disruptions come, the stock typically collapses 40-50% because we have earnings degrowth also and we have valuation compression also. Whereas in the B2C companies, the growth might be slow, but it would be secular. And even in case of challenges and disruption, you won't have substantial earnings degrowth, and the valuation also would be resilient, right? So like over time, I've started to appreciate this quite a lot after investing in a lot of different kind of businesses. Like I've tried to invest in everything, right? So what happens is even if you earn, like on paper, you earn very good returns in this kind of high growth B2B companies. But eventually what matters is, how much money you take home, because, in the end you have to sell also, right? And selling eventually is the biggest and most difficult part. Like it is very difficult to sell at the top. Either you sell early, you sell late, right? And if you sell late, basically in B2B, B2G, the kind of businesses, you're selling at least 30-40% lower, right? So the end return that you're taking home is not that huge compared to a slow, secular growing company, right? And it's not that in, a resilient businesses you can't find high growth. 20-30% growth you can find in secular businesses also. So, and I think there's a lot of examples. I mean, even if you look at professional fund management industry, I think over the last decade or so, the best anyone has delivered. I'm saying professional fund management industry is because that's a documented track record, and therein your approach is more sensibly. I mean, at an individual level, a lot of people can do a lot of things. So I don't look at that track record. The best anyone has done is like 25-30% only. Even after saying, investing in whatever approach you're saying, finding, maybe doing cyclicals, making 50, 100x in XYZ stock. Still, they have done 25-30% only. So that's an indication that, even if you're able to do XYZ in particular stock, your eventual returns are still 25-30% because, you also lose that much in other bets also, in similar kind of bets, right? So I think that is how I think people should approach. I think that is the portfolio creation approach that I've looked at over time. That you focus primarily on resilient businesses. It doesn't have to be like say quote unquote consistent compounders where you only have to buy Titan, but HDFC and all those guys. There are small mid caps companies in the B2C side businesses that are growing very far. Right? Just to give you an example, not a recommendation at all. Look at Safari, right? It's the what? It's a small cap company, right? But look at growth. It is growing at 30% for almost like a decade now, right? So you can find smaller companies which are B2C, which are resilient businesses, which is high growth also, right? So I think that is how people should approach. And for some part of your portfolio, you can do this high, high beta or high volatility bets. Like if you believe that the opportunity is very good, you have very good visibility and all that stuff. So like to give you an example, I think last 2 years, Dixon, I made good money on Dixon, even though I know the business is not that great and whatever, but there was clear visibility was there, right? XYZ growth is going to come. So at those times, opportunistically, you can get some alpha out of those bets, but you limit it, to certain percentage of your portfolio. I think for the rest part of the portfolio, you're more better, that it's better to approach portfolio with these kind of opportunities because another thing that happens is here your holding period is relatively longer. Whereas in case of, for example, Dixon, I exited in 9 months, right? Because obviously I know that eventually when the trend collapses, it's going to correct 50%. So there's no money to be made. So you in this kind of bets, you have to rotate again and again to keep that portfolio intact. And every time when you're rotating money, you have to realize that you're again testing your luck because eventually, no, doesn't matter how much work you have done. In the end, there's some luck angle to every bet that you make, right? So if you're rotating your portfolio every year, that's a challenge because for every new investment that you're making, you're again testing your luck, right? So I think that's a difficult approach to do, is what my understanding is. And this is over time. Like earlier, there was a time when I used to avoid B2C companies only because I thought, why to buy 15-20% growth companies? If you're getting 30-40% growth. But over time, with experience and one observation, you realize that, it's better to focus on resilient companies for the most part of your portfolio. And then, some part of the portfolio you can do, high beta alpha bets. And you'll still get like the 20-25% return, right? Compared to, someone who's taking a lot of risk and doing 30%. That 5% difference doesn't make sense if you're not able to do it for a longer period of time. Doing 25%, I think you can do it much longer period of time with much simpler approach, with much less risk and which much less, I'd say, stress and all that stuff.
So, Ankush, is there like any number of stocks which any range within which you keep the number of stocks and any percentage allocation criteria per se, or basically like if your conviction is high in some companies, so the allocation is big, or is it like equally distributed across the portfolio?
No, so the allocation part, see, eventually it depends on how much risk you're willing to take. But one thing that determines how much you should allocate is basically, see, a lot of times what happens is you say, this opportunity is very good. Let me say invest, for example, 10%, right? Which is on the very high end. I'm trying to give you an example. But what happens is if even if you go right and this stock becomes a multi-bagger, that 10% will suddenly become 20%, 30%. But you won't be able to hold it at 20, 30%, right? Because that's a pretty large chunk of your portfolio, right? Daily volatility will give you a lot of stress in holding that position. So you know that, post 20%, you're not going to be able to hold it. So investing initially 10% was not a good choice because you put a lot of money at risk, and then at just doubling, you're cutting that position just to keep your allocation in check and manage, and for a risk management perspective. So that is not a good approach. I'll say that you invest a large quantum in a particular stock, then you have to cut it just because it increased to a very large substantial part of your portfolio. Then for the risk management perspective, you should cut it. So invest only such percentage of your capital in a stock wherein you believe, let's say if you believe the stock can grow like 3 4x, that even when it goes to like 3 4x, you'll be able to hold that much size of position. Otherwise, the capital that you have put at risk is that's it's an inefficient use of that capital, because then you're kind of cutting that on the upper end, right? Rather invest low and let that position grow and use that capital in some other investment opportunity. In terms of number of stocks, see, it depends. In a lackluster kind of market, you might be finding a lot of opportunities and you might be nitpicking, like starting with smaller position. So at that time kind of frame, you might have a very broad portfolio with a lot of ideas, right? In a very strong bull market, you might have certain specific stocks, and you might be able to allocate a large chunk of capital in each high conviction idea. So that time your portfolio might be concentrated. So it depends, the kind of opportunities you're getting and how much you're able to allocate in those individual opportunities. So don't target a fixed number. Let your number of ideas and what kind of conviction you're getting in those ideas determine the number of stocks that eventually end in your portfolio.
So, Ankush, like protecting the downside, or to say the margin of safety, which we keep in mind always while entering a business. Like, so the valuation framework which you use broadly, if you would like to throw some light, I mean, as far as valuations are concerned, how you go about depending upon the business is, let's say, high growth business, or maybe some average business, like the consistent compounders and all. So what would be your suggestion that how we see the valuation, which is in itself a moving thing and no fixed number?
So valuation itself, I think it's one of the most difficult aspects, because the valuation, to be honest, is a very relative thing. In XYZ period of the market might be willing to give XYZ multiple to certain kind of opportunities in XYZ time frame. Market might be not willing to give XYZ multiple to different kind of that. So it's very relative. So the way I look at valuations is, I believe there are three factors that determine, a medium to long term sustainable valuation that the market would give, right? So the first and the most important thing is growth. Like the higher the growth, the higher the valuation you get. The second thing is, the quality of growth. So like the thing that I was talking about, resilience. So if historically a business has demonstrated that the growth is of high quality, it is resilient, then even in bad times, the market would devalue that much, right? So if you have a resilient growth, it's a high quality growth, then you typically get a valuation premium for that. And third thing is the kind of efficiency that the business generate, like the ROE, ROCs, and whatever, right? So depending on those three things, I think that is how the valuation that market determines. But there are cycles in the market, right? So if you see cycles of last 4 5 years, on the higher end, stocks are even getting 70, 80, 100 times multiple, right? On the lower end, you have like 15, 20 times multiple. But a decade back, this was not the situation. A decade back, the higher multiples were like 40 times, and the lower end was like low single digit, right? So you have to realize firstly, what is the kind of valuation band the market is working with, right? And then figure out, in this spectrum of valuation band, where does your stock fit in within the kind of growth, quality of growth and efficiency that it has, right? So that is how I look at it. And in the end, eventually, see, market works on a relative basis. So it chases the best relative opportunity. So I think now there's this whole debate, because last year what has happened is all the PSUs and all those guys have done well. So there's a lot of debate around, the emergence of value again, right? and that there would be substantial derating on the higher end parts, stocks that have seen re-rating for a decade, right? But if you step back and look for last 10 years, essentially what has happened, I mean, 2012, 13, you had stocks growing at 30%, trading at single digit multiple, right? Now you don't get that opportunity, right? So it's not that, only this high quality stocks have seen rating. I think the overall market in India itself has seen a re-rating, right? This high quality part have seen a larger rating, firstly because I think Indian market overall has matured, right? They have started to appreciate this quality of growth over and above, just the growth, the quantum of growth. So because of that factor also, there has been some additional re-rating that these companies have had. And then, you had 2018 wherein, for a very first time a lot of investors saw what it means for a good corporate governance, what it means safety, the quality of growth, take the front seat, what you should look at. So that time you had this again a factor that kind of increase the divergence between high quality stocks and low quality stocks. And then you again had COVID, wherein for the initial COVID disruption period, this high quality stocks did much better compared to this low quality stock. So that divergence, you know, expanded even beyond, right? But last year, what has happened is, the stocks that got disrupted, they came back, right? The earnings came back, the growth came back, like PSU banks and all that. PSU defense has not done anything for last 10 years. But since they were disrupted so much during COVID period, they came back, relatively the growth for these companies started looking very good. And so the market said that now this expanded valuation band has to contract, right? Which was if it was say 100% premium during COVID, it went say 200% premium. Just a reference point I'm giving, right? So now that piece had to correct. So that is what has happened over last a year and a half year. That the access that was made during say COVID period or 2018 or whatever, that has contracted. But the thing is that you even like in the medium and long run, something like an HDFC bank will always trade at a premium to something like an SBI bank. Like you can't expect that SBI bank will trade at two times price to book and HDFC will take trade in just 2.5 times price to book. That won't happen because in the longer run, everybody knows that HDFC's growth rate is higher, its efficiency is higher, the quality of growth is higher. So that premium would always be there, right? This quantum of premium will vary depending on the overall market condition, how different stocks are doing well. So if 1 year down the line PSUs starts to doing not that great, right? So market will shift money to the quality banks, right? Private banks, and then this valuation band say will further expand, right? So that is how you have to look at cycles, I think.
Right, great. So for our attendees, like I don't know, there is some issue or so. There are many speaker requests which are getting dropped. So in case you are not able to join, you can simply write the question you have in the comments so that I can read it out to Ankush. And in the meanwhile, I have my set of questions. So, Ankush, like when it comes to selling a stock, there could be a number of things, be it the overstretch valuation, or maybe the earnings are peaking, or maybe in the cyclicals, you can say the peak earnings kind of thing. And maybe so any technical angle also you use, or what all pointers you look for a sell thing. And one you already talked about, say if you have a big position within the portfolio and say it's 20-30%, then you have to trim the position, so that goes. Any other point which comes to your mind could be helpful as far as sell strategy is concerned.
So see, selling again, I think, like I said, I mean, so there's this well-known trader called Mark Minervini, right? He has a very good book on trading part of it. So what he says is that there is no right selling, right? Either you will sell early or you will sell late, right? And it's always better to sell early because what happens is if you sell early, even though you lose some money on the paper, you're emotionally you don't feel that bad than seeing a stock wherein you made XYZ money and then you lost it, right? So like what happens is typically the way you have to look at it is it's better to sell on say strength when the times are good, right? Because by the time things turned out, right, the stock irrespective of what kind of stock it is, it will already be down 20-30%, right? So if you're able to sell early, that's better, right? And then there are a lot of smaller things, right? Say the basic thing that I think one should follow is firstly, have if you start, say, if you got on a stock early, right, you'll obviously start with a higher allocation, right? So if say if you're looking at a bet wherein you believe the growth is going to increase, the valuation is going to expand, right? There, no one is tracking. It's like an underdiscovered story. So there you put a lot of money, right? But over time, as the trend plays out, the growth had stabilized at a certain level. The valuations are also expanded quite a lot. A larger part of market has discovered the stock, and a lot of people are tracking it. So from incrementally the kind of returns that you can expect is much lower than what you started with. So it makes sense to reduce your allocation, right? So if you started with 8%, right? Say for example, because everything was good, and now say if it has doubled, it's become 16%. So you don't trim it back to 8%, you trim it back to 4% because from here level, you don't have everything, right? You don't have an acceleration in earnings, right? You don't have valuation expansion. You don't have that discovery effect also, right? So I think over time, once you hold a stock, at every given interval, you reevaluate, what is the incremental return that you can expect, and then keep trimming your position to reflect that, and use that capital to go and invest in a different opportunity, wherein, for that percentage of capital, that opportunity might make sense, right? So I think that if you do this one important thing, I think by the time things actually turn downside, you won't be holding a very large percentage of your portfolio, and a large percentage of your profit would be unbooked, right? When things turn down, right? If you constantly monitor your position and you reduce your allocation, which is commensurate to the kind of opportunity that can, the kind of return that the stock can deliver. That is one thing. Secondly, I think the typical weight management, like I said, if if a position crosses certain percentage that you are not comfortable in terms of risk management, so say you don't want your each individual stock to go beyond say 20%. So like whenever it goes above 20%, you say trim it down to 15%. Then let it run again. Like if it again goes above 20%, you again trim it down to 15%. So this way you keep booking profits also such that your risk is managed, right? You're constantly booking profits at higher level, and you're letting your position also run, right? And these two things are mentally also, behaviorally also, it helps you because you have that comfort that, I don't have, say what happens is, say, you invested in 100, a stock goes to 500, then it comes down to 300, and then you sell. So the mentally, it feels very challenging that, you could have sold it at 5x, but you didn't. But if over time book profits, reduce your position, say at 300, 400, 500 also, you would have done it. So you don't feel the pain that much. Then you are fine that over time you have sold little position and you have used that capital to invest in something wherein you might have still generated incremental return, right? Otherwise, if you would have hold this entire position for this entire time without selling anything, the entire capital would be sitting in this one single position, and the end return is still that. Like for 100 it becomes 300, even though it went to 500. So I think that is one thing on the overall hygiene thing. Then, like in terms of stock specific, I think what happens is, I think I have this framework of 4 factors. I think it's there on our YouTube channel also. So typically, what happens is, for the most part, a stock tops out when the incremental return expectation, given the kind of growth valuation that you have, is subpar. Like it's like less than 10-15%. So I'll give you a good example over here, not a recommendation again. So like I held Dixon, right? So Dixon at one point of time reached this market cap wherein, you know, for me to say generate even 15% CAGR, the stock had to double in 4 years, right? 4 5 years, right? So then I reverse calculated it. So example, say Dixon gets like 40, 50 times earnings multiple, say 5 years down the line also, which is obviously higher for the kind of company it is, right? So what kind of profit you need. So it was at 20,000 crore market cap that time. So even if you expect that it will double, it would be like 40,000 crore market cap company, right? Say if you expect that it trades at 50 times earnings also, right? You get a profit of somewhere around 800, 1200 kind of number I was getting at that time. And then you look at it that, if Dixon is to generate 1200 kind of profits, you have this company's net margins are just 3%. Then this is the XYZ number of revenue that it would have to generate in say 4 years down the line. And then I reverse calculated it, right? This is the kind of growth it would be. And at that moment, it didn't make sense that, even if this company is able to achieve this kind of top line growth, still I make just 15%, right? So there was no point in risking that. So, I would say that, like, I don't know, should I call it luck or something? I exited Dixon at a very top, right? Just thinking from this perspective that incremental return doesn't make sense at this level, considering the fact that, there's a lot of hype in the company also. Like at that time, Dixon was like, everybody was talking about Dixon. So this is another factor, right? If you see, if you have a growth rate that is kind of topped out, that, the incremental returns are not that great, right? There's full hype and froth in the stock, right? Then I think it's better to, even if you don't want to exit, I think reduce position substantially, because for the most part, either the stock will top out, or for the most part, it won't give you decent return for at least next 1 2 years, right? It might go into consolidation in the best case scenario, right? And in such situation, if you have a liquidity event wherein stock split comes, bonus comes, or promoter comes to sell, then so it's 100% sell. Then for 99% in this situation, the stock tops out only.
Right, Ankush. I think there was one speaker, but he got dropped. I don't know what's happening today. There were many requests anyway. So, Ankush, what's your view on the current market situation and any good sectors or maybe good pockets where value can emerge if we have a what we say horizon of say next 2 3 years? Any investable pockets? It's not necessary to name a company, obviously, but any good themes or pockets for investment you would like to talk about?
See, the overall market as such is challenging, because if you see from last year, I think May 22 onwards, I think the market has consistently become much narrower. I think towards end of 2022 post Q2 results, there was some broadening, but with Q3 result, which again was a dampener, I think there's further narrowing in the market. So in such narrow markets, what happens is, even if some trend builds up, it doesn't sustain. So if you look at last year, I think there was some initial signs of, retail stocks doing well, auto stocks doing well, real estate. So all these things emerged, but nothing sustained, right? Last year, what did well was metals and PSU. But if you look at the initial 2 months of this year, both at the index level, they have seen like substantial fall of more than 15%, right? So in this kind of challenging environment, I think top down is, I think, much difficult to do, because that bullishness doesn't get created to lift the entire sector, right? Because the economy itself is also challenging, right? So it's better to look at, say, micro kind of trends, not like sector specific trends. In certain sectors, you might get some micro trends. So I think this is just my understanding that on the retail side, the non-discretionary items, I think even if you would have seen last quarter, the non-discretionary did not do that well. I think even though overall retail part would be challenging, but I think the very premium luxury end would do well. Even if you look at autos, the lower end is not doing well, but the premium end is doing well. I think from that perspective, you can find those kind of micro trends in specific industries, and you can bet on them. But it's better to do bottoms up. And if you have to look at some of the opportunities, I think last week only, one of our weekly insights, we talked about this neglect and disruption area. So if you look at last 3 years, what has happened essentially in the first 1.5 years, uh, though there was a lot of disruption, that disruption uh, contributed positively to a lot of companies, right? Pharma companies got a lot of demand from COVID also, and from the shortages also, right? A lot of commodity-led companies also made a lot of money because all the commodity prices got higher. Like something like pipes company like Astral and everyone got into, super normal profit margins because PVC prices were going higher every month and they were making a lot of inventory gains. Right? You have something like IT where, demand came, there was a pent up demand that came, and, market also rewarded it. The liquidity was abundant. So, a lot of startups got listed at a very high valuation. But after 1.5 years, that thing has reversed, right? So commodity prices started coming down. So someone who was making abnormal profit margin are now making subnormal profit margins, right? Pharma companies, everyone, got affected because of high channel inventory, reduction in API prices, the competition came back. You know, tech tech also side, after the initial pent up, slowdown has come up. Startups got substantially derated because liquidity got tightened up. But what has happened is a lot of long-term growth opportunities are kind of under disruption. So you might be able to find some value on those bets because earlier they were making supernormal profits and they were trading at supernormal valuation on that supernormal profits. But now since those things have reversed, it has gone the other way. Now they're making subnormal profits and they're trading at subnormal valuation, right? So you might get that mean reversion plus growth play. So if you have an opportunity where you believe the medium to long term growth story is intact, and currently it is going under disruption, you can actually invest in those ideas wherein once the disruption goes away, you get the initial re-rating, which is sort of a mean reversion, and then on top of that, you'll have your long term growth story, right? So that is where I think you should look at. Same thing, I think with there are a lot of opportunities which are currently neglected, right? Because in all if a company is doing a lot of things over last 3 years, but on the industry level if there is disruption, so the overall number doesn't reflect the kind of good things that has been happening with the company, right? So, and there are a lot of such opportunities as well, where some of the companies have done a lot of good work, right? That good work is showing off if you go in the details of the company, but on the overall level, it's not reflecting because at an industry level there are challenges and such, and so the overall numbers are not looking good. So therein also, when this disruption goes away, that changes that they have done, the positives of that will start reflecting. And then also there also you'll get, the initial mean reversion and then a growth on top of it. So I think that area, I think this disruption and neglect, I think there are a lot of opportunities in that. And there people can make a lot of money, I believe. So that is where I'm focusing at the moment.
Right, Ankush. So, Ankush, like any good books to recommend to our attendees, obviously related to investing, which can be beneficial in their journey.
I personally have not read that many books. So I think I have till now I've read only three books to be honest. One was William O'Neill's Can Slim. I think that everyone should read just to get a basic idea of how one should approach investing. Right. Second book I think I read was Mr. Basant Maheshwari's Thoughtful Investor. The only reason being that it's a good book because he has given perspective of Indian market, right? So you get a good understanding of how the Indian market works. What are the kind of companies and some of the biggest winners of the past, which he captured. He has narrated the story of that. So that gives you a very good understanding. And since it is written in the Indian context, there are a lot of good takeaways from that. So I think broadly I've read only those two books, and lastly I read Mark Minervini's book, but that is only from the risk management perspective and capital allocation perspective if you have to read. Otherwise, I think if you spend more time on researching stocks, I think that learning is much better. So you research a stock, you put some money, even if you buy one share, just buy one share, and just observe what you thought would play out and what played out, and learn from it. Because what happens is even if you invest 1 rupee in a stock, now you start tracking it. You'll go to con calls, you'll see results. So that kind of experience and learning you won't never get in any kind of book. So that is just my perspective. A lot of people might get some benefit of reading books also, but since I have not read many books, I cannot suggest anything.
Great, many thanks. So, Ankush, like before we close, if you would like to tell our attendees about Search Capital or yeah.
Sorry,
So,
since your voice was breaking, I couldn't hear you.
so, so, like before we close, what exactly you have? I mean, you offer at Search Capital, or means if you would like to talk about that before we close.
Yeah. So Surge is basically an equity research service. Like the layman parley term is advisory services, right? So therein, basically, I try to provide. Basically, it's just a leverage of what I do full time. So the stock that I buy for myself, I basically try to put it out on the platform for people who are interested in stock ideas and those stuff. And then we also provide some very good research reports on that. So typically the advisory or say research market is largely reliant on stock names and one to page notes. What we do differently is basically provide, detailed research reports on stocks. So it's a research-led recommendation service, not just a recommendation service. And then along with stock ideas research, we also have something called a knowledge base wherein we share research and also, you know, frameworks and ideas on how to invest, business models, investing frameworks and all that stuff. So it's a learning plus recommendation kind of service.
Great, great. So, Ankush, thank you so much for your time today, and it was really insightful knowing the perspective from your end. So any closing remark before we close? Anything you would like to suggest or tell to our attendees?
Nothing much. I think, uh, do we have a Q&A or like we're closing it?
We had many requests, Ankush, but I don't know what's happening today. There is some glitch on Twitter Spaces or what. People are getting added and they get
Okay.
dropped. I do not understand what's happening. So, anyways, there are no
Uh,
questions in the comments, and I am done with my questions. Perhaps the Q&A we can keep for some other time in case we are unable to do that today.
uh, Nothing
So,
closing comments as such. I mean, if there are questions, I could have addressed it. Otherwise, I think I've shared whatever, questions.
yeah. So we can keep one session sometime down the line for Q&A specifically. I don't know. I added some 7, 8 odd people, and they got dropped. Maybe some issue on the Twitter
Yeah.
Spaces. So, anyways,
No
it was
worries.
a great session. And as far as like framework is concerned, we discussed the nitty gritties of forming a portfolio and how one should go about diversifying and what all angles one need to see as far as management is concerned, and the sell thing which is the most important in the market. So pretty covered all the aspects, and
Right.
so obviously we always have so much to talk about investing. So down the line we can
Yeah.
also have some Q&A dedicated. So thank you, Ankish,
Sure.
and thank you so much for your time. So the session was recorded and I'll be uploading it over YouTube. So those who joined it may get benefit by revisiting the session. So thank you guys, and we'll be meeting again very soon. So take care, and if you're liking our work, do appreciate and give a feedback, and you can also follow us if you find value in our work. So thank you, Ankush, and everybody who attended today. Good night. Take care.
Sure, yeah.